Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of double shot interviews. And this is our weekly currencies review and outlook with Dan Bell from HiFX. Dan, welcome back to interest.co.nz.
Thank you.
We love looking at the area of currencies, what's happening on the global markets, what's happened in the last week going forward. And in the last week, most of the action on the global markets has been around Europe. Concerns about what's happening in Greece and what fallout there might be for the European financial system. What was the events? What are people focused on with Greece at the moment?
Yeah, well, the whole situation in Greece is starting to look like a slow-moving train wreck. Every sort of second day, we're getting more sort of negative news, if you like, out of Greece. Most recently we've just had one of the credit rating agencies have downgraded their credit rating to essentially junk status. Spreads continue to widen out, and that's having an impact on the other peripheral countries as well. So, Greece is in a lot of trouble, as most of us know. They're talking in the back rooms about some type of restructuring or reprofiling of Greek debt. We're going to have to see some kind of resolution there within the next couple of weeks, and a lot of the sort of negative sentiment that we're seeing in around Greece. Also issues in Italy with one of the credit rating agencies downgrading their outlook. Elections in Spain over the weekend, so they're going to get a change of government there. So there's a lot of issues going on in Europe.
Let's dig into that reprofiling issue, as they say, which for a layman's point of view really means extend and pretend. They're talking about changing the rules around how quickly that debt has to be repaid. What are the risks there for the European banking system?
Yeah, so the risks there are, ultimately the European banking system, and the Greek debt is held by European banks. So ultimately, if we did see some type of haircut or some type of extension or reprofiling, that cost is going to have to be sucked up by someone, and that someone is going to be the EU, obviously the IMF and the European banks. So there's that potential contagion and spillover that the European banks will have to take some of that cost.
And how is this all affecting the euro versus the US dollar and the New Zealand dollar?
Well, amazingly, the euro's actually held up remarkably well considering what's going on. So, the euro pushed up to sort of 143.5 last week after dropping to a low of around 140.50. But over the weekend, we've seen it back under pressure, currently just sitting just under 141 against the US dollar. The Kiwi versus the euro is trading up around a 3-month high, just over 0.56 over the weekend. So a lot of the issues in Europe are being reflected in the exchange rate. In the background, you've still got a lot of the forecasters, the economists that are predicting the currency around the world, suggesting that the interest rate differential between the euro and the US dollar is still going to be the key driver. But just over the weekend, we've had one of the main investment banks come out and actually change their view. They've gone negative on the euro. So it'll be interesting to see how that plays out, because if you look at the sort of net positioning in the markets as far as where the speculators are positioned, they're still net long the euro, and they're still thinking that perhaps the interest rate differential between the euro and the US dollar will come back into play, and that'll be the focus. But personally, I think there are bigger risks associated with the situation in Europe, and I don't think they're going away anytime soon.
Now, on that interest rate differential point of view, that's Europe. Now, the United States, everyone's looking at monetary policy there, how the economy's going, and whether the Fed will be able to keep its hand off the tiller after it stops pumping money in on June 30. What's the view on interest rates in the States, and what's the economy doing there?
Well, the monetary policy setting in the States is still, extremely accommodative, and they are ending quantitative easing, or the second round of quantitative easing, at the end of June. I think, for the US monetary policy, I don't see them introducing some type of QE3, certainly not this year. I think the conditions for a QE3 would be very, very negative, so we'd have to see some kind of significant deterioration in the US economy and in the global economy, for that matter, to see QE3 launched. So I think the US Federal Reserve are going to end the quantitative easing, and then they'll be talking about raising interest rates at some stage, probably the last quarter of this year or the start of next year. So you're going to start to see investors positioned for that. At the end of the day, their rates are 0% or 0 to 0.25%. So even if they hiked a few times, we're still at a very, very low interest rate setting in the US, so nothing to get excited about. But I think broadly, seeing a little bit of a change in sentiment out there towards the US dollar at the moment with the situation in Europe.
Now, looking at those interest rate differentials between the United States at almost 0 and New Zealand 2.5, Australia 4.75, Australian and New Zealand dollars versus the US dollar, what have they been doing?
The Kiwi dollar actually, we pushed up to almost 80 cents over the weekend. It was a little bit of a confusing night on Friday for the markets. We had equities sold off, commodities went up, the New Zealand dollar strengthened against the US, but has actually come under some pressure this morning. We're trading back around sort of 79 cents. Last week we got down to a low of around 77.50, so the range at the moment 77.50 up to sort of 80. The Aussie to US has traded as high as sort of 107, just over 107, and last week was as low as 105. 05 was there or thereabouts the low. So you're seeing a little bit of a downtrend of sorts develop in the New Zealand dollar versus the US and the Aussie to the US for that matter. So the highs have been lower and we are starting to see sort of lower lows. So this has also been reflected in the global equity markets. Equity markets in the States made another low last week, so that's the third week in a row that the equity markets have closed down, and it just feels like the worm has turned as far as the global risk outlook.
And commodity prices are a big sign of that, and New Zealand dollar and Australian dollars tends to move with those commodity prices.
Well, commodity prices have actually still held up reasonably well after that huge sell-off we had about a fortnight ago. But again, they continue to look like there's probably more weakness going forward. And I mean, even if we saw some type of 5 to 10% correction, I don't think people would start to panic about that, because the run-up that we've had over the last 6 to 9 months has been so significant that I think we'd be all quite happy to see a decent correction in the oil price.
That's right. Now, one of the other factors dragging on the markets in the last week has been the very poor numbers out of Japan. Tell us about that.
Yeah, so the GDP numbers out of Japan last week for the first quarter came in at almost minus 1%. So their year-on-year GDP numbers are close to minus 2%. And that's obviously reflecting the earthquake and the tsunami that Japan had in March. But we're also seeing a flow-on effect of the weaker supply chain and the disruptions in the supply chain around the world. So I think some of the weaker data we're seeing out of the States, for example, is reflecting the supply chain disruptions in Japan. And Japan, I mean, their finance ministers have been out recently saying that their economy is in a pretty bad way. The Kiwi dollar versus the Japanese yen hasn't really moved a great deal. It's moved a lot, obviously, from the lows that we had back in sort of March. We're still sitting around the sort of 64 to 66 region at the moment.
Now, looking ahead in the next week or so, what should people who are trading currencies, looking at markets, what should they focus on?
Well, I think we'd be watching the key level in the euro versus the US dollar is 1.40. So I think if we saw a break of that level, it could open up quite a significant downside sort of move. And that could probably put a bit of pressure on the New Zealand dollar versus the US. So traders will be watching that as a key sort of leading indicator, if you like. We don't have a lot of data to speak of that's coming out of New Zealand or Australia this week. Later on in the week, on Friday, we've got GDP out of the States, which is expected to come in about plus 2.2% for the year. But I think the unfolding of the situation in Europe, obviously, and that key level in the euro versus the US at 140, and the key level in the Kiwi versus the US at 77.50. If we see a breakdown there, I think we've got probably more downside.
So we'll all be keeping a close eye on the back rooms around the Greek discussions. We'll know all about Greek politics and Greek monetary economics over the next couple of weeks. Dan Bell from HiFX, thank you very much for coming in for our weekly currencies review and outlook. I'm Bernard Hickey from interest.co.nz.